Algorithmic trading from first principles. This is going to be a practical guide to building a robust rule-based trading systems that can work in real market conditions. So let's just jump into the video. Okay, so first of all is what really algorithmic trading actually is, right? So the reality is algorithmic trading is the systematic execution of predetermined rules under specific market conditions. It's not a prediction machine or a profit guarantee. Most, like normal or retail algos fail because they confuse indicators with strategy or automation with edge. They think that, once they have that automation or once they have that trading algorithm, they're going to get rich, right? Which is not the case. And there's some critical distinctions that we have to make here. It is a bot, a trading bot when it executes orders, an indicator that measures price, or a strategy defines entry and exit logic. These are all just, to be honest, gimmicks, if I would say, right? Like if you really want to get into algorithmic trading, you have to think ahead of these things. A system is actually what you need, right? A trading system, aka a trading algorithm that manages risk, execution monitoring, and failure handling across changing market regimes. So let's just go into the next slide. And by the way, this has been developed by our team over at Nexus Ledger. So okay, the third slide is basically how markets actually work, right? So markets don't usually work because there are more buyers and there are less sellers, and more sellers, less buyers. No, whenever for every buyer there's a seller, right? Because for example, if I'm selling one share, right, and it gets executed, there has to be a buyer of that one share, right? So in that perspective, you think that if there are equal buyers and equal sellers, how does the price actually moves up or down, right? Because it's not that the quantity of buyers or sellers that matter, it is actually the pressure of the buyers and sellers that matter actually. So I'm going to teach you more in this slide. So understanding market microstructure is more valuable than any indicator. Price moves because of order flow imbalances, which is 100% true. Not because patterns want to complete and there's like hidden patterns in the market and there's like ICT or all those gimmicks. No, it's just because of the order flow imbalances, because of the aggression from one side. When you place a market order, you cross the spread and remove liquidity. When you place a limit order, you provide liquidity and wait for aggression, which is 100% true. Now, there are three things that I want to tell you in this thing. So number one is order matching. So exchanges or brokers match orders using price time priority. Okay. Aggression determines execution. Passive orders sit in the book. Aggressive orders take liquidity and pay fees. Why price moves? Imbalances between buy and sell pressure deplete one side of the book. Larger orders absorb available liquidity, and microstructure shifts happen before indicators react, right? So this is the reason why price moves. Simple as that, because of the imbalance between buy and sell pressure, okay? What algos exploit? So temporary inefficiencies, mean reversion after overextension, volatility patterns, and time-based behaviors, and more things. Okay, this is what algos actually want to exploit to make money. Simple as that. It is usually not prediction. It is a reaction to measurable conditions. Indicators basically usually lag microstructure. So, there are most of the indicators that people use or they flaunt upon, they are lagging. Okay. And especially they lag really behind market microstructure. So by the time a moving average crosses, and informed traders have already positioned. Okay. So build systems that respond to conditions, not delayed signals. All right. So you have to get out of that indicator mindset. Now we come to the logic design. So from trading idea to executable rules, turning discretion into logic. Manual traders use intuition and context. Algorithms require explicit conditions. This is like really important for you to understand. If you cannot write down exactly when to enter, exit, and stand aside, you cannot automate the idea. It is impossible to do that. common mistakes that I see, and even at at Next Ledger we see is that people will come in and they would give us like wake conditions that we want to automate this system, that we want to automate this system or this trading strategy, but they give us wake conditions, right? Like strong momentum or oversold or when the price is like going this way, etc., etc. Ignoring and like invalidation scenarios, forgetting to define when not to trade, assuming the edge persists across all market regimes. So what you should actually do is define precise entry triggers with numeric thresholds. You should specify invalidation conditions before entry. You should document no trade stats, and you should give us like a test rule clarity that can someone else code it from your description, right? So you need to have these things to be able to turn discretion into logic, which is really important. Okay, now there's a test for you, and that is if your trading idea cannot survive this question, it's not ready to automate. So, what exactly happens if condition X occurs at time Y, right? Ambiguity destroys backtest and live performance. Precision enables actually robustness in your system. So, let's just go into the other slide. So, risk first system design. Edge is not alpha. Edge is basically in trading, surviving long enough to capture alpha when conditions align. Okay, so professional systems prioritize risk controls over entry signals, right? Like professionals and experts who are into algo trading and into trading, they really don't want to lose money, right? Once you take care of like not losing like money, then the alpha takes care of itself, right? The profit comes itself in most of the cases. So position sizing, drawdown limits, and regime filters matter more than prediction accuracy, right? Like knowing when your edge is actually executable and should be executed, it is very important. The timing to know is very important. Position size logic, so you have a couple of things here, like for example position sizing logic. So do you want to go with fixed percentage of capital per trade, or do you want to adjust for volatility, or etc., etc. So then the second thing that you have is drawdown control. So for example, you want to define maximum tolerable loss before pausing, reduce size after consecutive losses, implement circuit breakers for unexpected volatility. When not to trade, right? So low liquidity, major news events, spread widening, post loss, cool down, and a lot of more things. So why risk is edge, right? Survival, allows a system to compound, right? It allows compounding. So controlled risk enables psychological discipline as well, and also it enables a lot of room for your trading system, for your algo trading, to perform better. So risk management separates professionals from gamblers, and we all know that, right? But we should execute on this idea as well, that you really need to have a good risk management system in your algo trading. Okay, so the realistic algorithmic strategies, the most famous ones, I'm going to talk about them in here. So for example, the number one is mean reversion. It's very simple that it works in ranging environments, ranging markets with defined boundaries. It fades extremes after overextension. It requires tight stops and quick exits, right? And fails badly in trends. And the second number is actually trend following. It's the opposite of like mean reversion. So it tries to capture sustained directional moves, requires patience and drawdown tolerance, and high win rate is basically not required in this because it has asymmetric payoff structure. So you would making 1 to like 4 in your risk reward, right? So if you're putting in $1 of capital at risk, you would be making $4 in return. That's at least what you expect. So, but the disadvantage of trend following is it chops during consolidation. Okay. Now the third number is time-based edges. So time-based edges basically mean exploits that recurring patterns at specific times, like for example open, close, session transitions. So it has a smaller edge, but it is highly consistent. Okay, but it is also arbitrage away very quickly. Like for example, recently we had discovered that in a specific asset type, for in the New York session, it would always like mostly go bullish for the first few seconds, right? We had discovered that and we implemented that for someone. So that's a time-based edge. So number 4 is volatility systems. So it basically means trades expansion and contraction cycles. It buys options before volatility spikes or sells after. and this requires an understanding of volatility regimes and Greeks, right? But you can also do this volatility systems in futures trading as well, right? So let me drink water for a second. I was okay. So there are arbitrage opportunities for algo traders, right? We a lot of times hear about arbitrage opportunities in different markets, in different asset types. So I'm going to talk about them in here. So what retail traders can access is true arbitrage opportunities for retail are limited, but they exist, right? But mostly they require like speed, capital efficiency, and understanding of execution costs. That's why most of the people don't try to trade arbitrage opportunities, and but there are a couple types of arbitrage opportunities as well. It's just not like the simple one where you're buying low and selling high in multiple brokers. There are multiple other ways to arbitrage. For example, statistical arbitrage, it exploits temporary price deviations between correlated assets. The second one is like in funding rate arbitrage. It is very specific in cryptocurrencies, so it captures predictable carry in perpetual futures markets. And cross exchange inefficiencies, it basically price discrepancies between venues with sufficient size. Okay, that's what it is. And they're like, there's one problem that I talked on earlier, that there are execution limits, right? Retail cannot compete in latency sensitive HFT arbitrage. Okay. But there's also one advantage that retail has that institutions don't have. It is institutions don't usually want to play like very small money games because they have huge liquidity, right? So retail traders can get into those small venues and try to arbitrage. Okay. And also, arbitrage sounds risk free, but it is not risk free completely. There's like execution risk, there's capital lockup, there's exchange failure, right? There are multiple other things that can go wrong, even in arbitrage opportunities, right? So you have to factor those things in. Okay, now a very interesting one is backtesting versus live trading. A lot of times we would see, on YouTube or on LinkedIn or Twitter that my backtest has performed so much good, and I would be making a lot of money, right? But in the most cases, those are not true because backtesting and live trading is hugely different. Okay, so a strategy that works flawlessly in backtest can fail immediately in live markets. The gap between simulation and reality is where most retail algos die. So professionals test not just for alpha, but for robustness under adverse conditions. So it goes into like these three stages. Number one is backtest. You backtest it, right? Because at least it needs to be good and better enough in a backtest, right? If it fails in a backtest, then absolutely it's going to fail mostly in the live trading as well. So first you do the backtest and then you do the paper trading. So what is paper trading? It's basically just simulated execution with realistic delays, like in a demo account in a exchange or or in a broker, and then you pivot to live trading. Okay. But there's also a way to make backtest like really good so that you know that this would work in live trading environment. And the ways are basically you have to see why does a backtest fail in live trading, and most of the reasons why it fails is look ahead bias, survivorship bias, overfitting, ignoring costs, regime changes, liquidity assumptions, and all those things. So if you factor those things into your backtest, then it can be extremely close to live trading environment. So now it is what is the professional trading system components, right? So I'm just gonna go a little bit over on this, not too much, because this is just like a theoretical side of how the components work in a trading system. So number one is the data pipeline. So in the data pipeline, you ingest and normalize market feeds, right? You have the data set, and then you're cleaning it, and then you're working with it, and then you have the strategy logic, right? So in the strategy logic, you basically try to generate trading signals, and then you have the risk manager where you try to validate and approve signals, and then you have the execution engine where you route orders to venues where you're going to place the trades, and then you have the monitoring system which tracks health and performance of your algos. Now let's just go into algorithmic trading learning roadmap. So if you want to learn algorithmic trading, right, and want to do it for yourself, or you can hire us and we will do it for you. But whatever you choose, the path from beginner to competent system builder is measured in years. Actually, it takes years to get an expertise in developing algorithms for trading for yourself, and shortcuts lead to expensive lessons. And you have to focus on fundamentals first, like for example, how does an algo works, why does it works, and watching videos on these things like you're watching this one. And then the automation comes secondly, right? So many traders code before they understand markets, right? And this fails reliably. So the number one thing is you have to understand the markets. Learn auto types, market structure, why price moves. Learn market, microstructure, and then you have to study successful manual strategies, understand risk management. No coding yet. Okay, you don't have to do any coding, and then you have to get into the phase two, which is turn discretionary ideas into explicit logic. So you have to turn your ideas into logic that you can understand and even teach a child. Okay, so you have to document those conditions and validations, position sizing, and then you go on and write, pseudocode, and then you write the real code. Okay, so now then comes the technical skills. So you have to learn Python, or like for example, you can learn Rust or C hash, and then you have to master data handling, API integration, backtesting frameworks, and start from building small tools and simple tools. And then you have to get to the phase four, which is system building, which combines trading knowledge with technical skills. Build modular systems, test extensively, start small, iterate, based on live results. So really it's just a balance of like 60% trading knowledge and 30% coding ability, and then 10% it is infrastructure. Understanding why markets behave matters more than coding speed. Okay, you have to understand, like for example, risk management and those things. Okay, starting your first algo project. The practical first steps would be begin with simple, well understood concepts, automate only after proving the logic manually, and avoid complexity initially. I know complexity sounds very fascinating and sexy, but it's not good for you. Okay. So startup project ideas would be like, for example, mean aversion on single liquid instrument with clear boundaries, or order book imbalance detector, right? And realistic expectations are like your first system will lose money or break if you're just starting out in algo trading by yourself. And this is normal and necessary, right? So each failure teaches more than theory ever can. So expect like 6 to 12 months before a profitable system, and then you can go on with your journey. Okay, focus on the process, not on the outcomes. And yeah, so there are some resources worth studying that you can start. One is Algorithmic Trading by Chan, I think that's the author name. And second is Trading and Exchanges by Harris. These two books are really good. And also, I would recommend, if you want to get a little bit advanced on backtesting, you can read this book. And you also should read academic, I don't know why I'm starting, but academic papers on market microstructure. So avoid marketing heavy courses and signal services. Just get down and get your hands dirty. That's what my message from Next Ledger would be. And if you want to build your own systems, right, and don't want to handle all the code and all those things and system designs and everything like that, you can contact us below on the description link, and you will go onto the page and submit your form. Thank you for watching the video. I hope you have a good day.